getting you what it wants. So I just want to open it for a second, because I don't know what we can get out of this, and I'd like to find out. So by the end of this, I'd like to know more or learn about anybody? Anybody?
Just, I guess, Series A terms, what are vanilla, what are not.
Okay. Anybody else? Nobody's looking to get anything out of this. This makes my job so much easier. So this is the way it's going to work. The voice you just heard is one of our panelists. And to some degree, maybe we'll be asking questions, maybe we'll be role-playing them. And I want to do that starting at 7 o'clock, so we'll have some time to at least get settled in and think about our own positions. Now, how many people have ever seen a Series A term sheet? Just trying to get you out of here. Nobody? Is that right? No, not at all. Well, I should say not at all. Depends on how it's structured. And did anybody come to the cap table workshop? Yeah. This is the guy, if you have any capitalization questions. He's going to negotiate you, and he's just going to smoke you. So I'm going to have to do a little bit more. And how many of your portfolio companies here have fun? Excellent. Good. This is just my way of contributing. So I'm glad you guys enjoy. I used to do this sort of thing within a large firm, 11,000. Not the bill. Okay. I've been doing this for about, again, my name is Ettinger. I've been doing this for about 16 years. I came to Silicon Valley right around the dot-com boom in '94. My first client was the largest ISP, Apple Computer, and Intel. And since then I moved one from the public companies and the larger ventures of the big to the smaller ones as they're starting out and through the entire life cycle. That's my experience. So I kind of eat and breathe this kind of stuff.
Why'd you make the change?
From where to where? Well, I went from Pillsbury Winthrop, to a startup company. And I don't know if it was in the bio, but it was one of those ones where you raise a lot of money and you get a bunch of good names. And then I just sort of wanted to break out. And at the time, the big firm practice as much. I actually was one of those people that enjoyed it. I can't say that about any of my associates, although my partners enjoyed it, because there was good collegiateness. And I just wanted to try something else. It was just sort of a nice, fun way of practicing. The other thing is being more accessible. Right now, for instance, my firm back built my rate probably close to about $6.50 an hour. It's really hard to really be with your client every step of the way. You sort of have to make sure you have a team, make it more affordable and more responsive. So it was a different way of practicing where I could really be almost a virtual member of the startup team, being their in-house general counsel long before they could afford it. I think that's it. I'd like to say. I moved down here about 4 years ago. The panel tonight, there's going to be, has everybody read the bios? Because then I don't have to do as much. Anybody did? Okay. And you know who they are. I cut out a lot from the bios. Most of them have a lot more things that you, at least I go, wow, that's pretty impressive. Well, I want to break this out is, I want you guys to think of the term sheet and these terms pretty much falling into two camps. The control camp, it's about controlling your company, who's going to control it, how they're going to control it. And the payout camp, okay? Who's going to get how much money if there's a good exit, or any exit? Right? Sell the company, go public, if it dissolves. Now, almost every single issue affects both. But I think one's more dominant than the other. What I want to do is break the people up that are here into two different groups. One is the P team, or payout. You guys are going to take a look at those terms. And the other one's going to be the C team, for control. And of that, I'm going to go 2, 4, 6, 8, 10. John, you want to do this, or what's that? You want to be on one team? Yeah. John, I'm going to assume from SC business. Ernie is an MBA. So if you want to, I'll be on one on until we get that. So there's 10 people. Group up with, let's have 5 and 5. Okay, and of those, 2 of you sit on one side and decide who's going to be the investor, and I guess 3 of you sit on the other side. Does that make sense? What do you think about whether or not I want to break it down and talk about that? I think because you guys aren't that far up to speed, you haven't really looked over term sheets much or looked at some terms. It would be helpful to have two people or even 3 people on each side, right? Because you can share information or insight. I'm actually going to throw you in there pretty quickly. I'm just going to go through the key terms that we're going to talk about. And kind of let you in there just to sort of be getting a feel for what the hell terms really come into play later on. And then we'll get really, hopefully by 7 o'clock, we'll have some really Wednesdays joining us.
Keith is going to be before 6, before 7.
I teach us for we don't want to. It's not like that most quarter before 7. We only work 10, you know, something short. So we're getting the all the time, I think. Yeah. Yeah, hopefully we'll have some hairy, difficult ones or some terms that just piss you off. And, you know, what we can do is sort of throw it over at the panel rather than again me pontificating on my experience and what I've seen. I'm happy to do that. It should be very interactive at any step. You know, if something's completely clueless, or if you just have something interesting that's or a good question, not a bad question, but it's on topic, feel free to do it now. We don't have to wait till the end. Let me do this first. Let me point out what we're going to be discussing and negotiating. And then you break up and try and do it to the best of your abilities for the first time around, okay? That makes sense? So it would be great if we could do, so this is a term sheet. First of all, let me describe it. They come in different shapes and sizes, slightly different wording. This is pretty much a Wilson Sonsini literature society format, which is one of the big 6, some of them 7 firms. In Silicon Valley, some might say the biggest. I think everybody would agree. It's one of the cleaner ones. In other words, the language is less difficult, which is why I'm using it. You will, however, see much more spelled out term sheets than this. This becomes more or less this. And I can read pretty much from any page, and it will just sound absolutely wonderful. In any particular jurisdiction in which the company will be required to execute a general consent to service process affecting such registration, qualification, and compliance, unless the company is already subject to service in such jurisdiction, except as may be required by the Securities Act. It's one of the sections. This is, if all of you guys have key cards over here, the security company is called Carry Systems. Just by coincidence, I used to represent them. This is their Series C, which is going to be a little bit bigger. This is the 3rd round. Than a Series A. But this is theirs. And theirs isn't going to be much. Regular Series A is probably something like this, depending on the attachments. Okay? So this sort of alludes, though, to there's sort of there is a one-to-one correlation between this and which documents are in here and what it's going to say. But we asked about sort of vanilla and what's vanilla. Pretty much. Even an attorney with very little experience can pick one of these things up and go, where the hell's this section? Or this looks a little funny. This is isn't normal. There's sort of a range of normal. I hesitate to call it standard. And so we have a pretty good. It's been normalized enough and modularized enough where we can do that. We also know that, for instance, if this term sheet has redemption rights, which is the investor's ability to force the company to buy back the shares that it bought, it probably doesn't come from this coast. It probably comes from the East Coast, because it's very, very rare. Probably in up rounds, 6% of the rounds. I probably have actual numbers on that. So we're pretty familiar. Does that begin to answer the question? Let me start just going through this. So the idea is you're raising money. In this case, what happened is an investor came around and offered your company Techco. They're offering you, what are they offering you? I'm sorry, they're offering you, because I scratched up to something else, $4,050,000. Mine is slightly different than yours, I believe. That's right. Right. Yeah, sorry. Everybody has one? No, give some action so we walk in. So they're going to give you just over $4 million. And in doing so, they have to value the company. When they're going to value the company, I'm going to say your company, before I put my money in, is worth $6 million. Right? So after I put in my just over $4 million, how much is the company going to be worth? Anybody? 10. It's over 10. 6, give me 4, just afterwards is 10. Basically, you do some math, and we did this in the cap table workshop, so we're not going to get too deep into it, except when we highlight one of the issues. But it comes to that number of shares and that price. And this is very ordinary. In fact, when you look at the deals that have been done over the last 2 years, It's kind of bizarre how normal, what range it is in terms of valuation and the amount of money being put into the Series A. And I've got actual numbers, at least Wilson Sonsini's numbers. I've got these numbers somewhere else. Price Waterhouse also put something together. But this is pretty typical, which is strange when you think about it. It shouldn't be typical, right? And this is kind of gets owned by Team P, right? Because how much shares these people are buying is going to affect everybody's ultimate payout. If somebody comes around and buys a company for $10 million, $100 million, and your investors own the number of shares that gives them 25%, putting everything else aside, they're getting 25 million out of it. So obviously this is a payout issue. So if they didn't own 25%, they'd be getting all of the other dumb shareholders would be getting all of it. And I know that I'm going kind of for you people that have some experience with it. You know, I kind of love it. I want to go a lot higher fast. Liquidation preference. And I'm not expecting people to know what liquidation preference is, but who knows what liquidation preference is? Right. Liquidation preference goes like this. And this is one of the oldest terms. This has been around in preferred stock probably for 150, 200 years. The idea is I have preferred stock. I'm the investor. So I told you guys to wear hats, right? This will help a little bit. You guys aren't wearing them, so I'll do the door. So I'm the investor. My investors have, they don't really wear hats. They don't have golf clubs and really expensive bicycles. Really expensive bicycles. Here's my head. I'm a preferred investor. And the one thing about being a preferred investor is if you guys dissolve the company, or we're closing it up, or if you guys sell the company in the future for $2 million, in other words, in my eyes, it's kind of a complete failure. I'm not investing in the failure. So at least I should get my money out first. And this position, I'll just let you know, is not negotiated in general. Very, 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 very few deals get away from that. And by very few, I'm talking 6%, 4%, somewhere around there. Certainly under 10%. The next piece of it is this, is as an investor, I don't just want my money back. I still want to participate with you guys on all the money that's left. So yeah, if I'm putting $4 million in, first I want my $4 million. But after that, we're going to be sharing, there's all this money, it's kind of like rain, right? And each of us has a certain amount of square footage. Let's spread it around. So for the money that's left, we divide it up by the number of shares, and that's how much we all get. But I get $4 million first. Now, what gets argued is whether or not, well, just let's go ahead. That's the investor's position. Now, in this case, the investor's saying, but you know what? I'll tell you what. I'll continue with you guys, but only until I get 5 times my original investment. So I'm putting in $4 million. Obviously, we're talking about term sheets and the different issues in term sheets. There are 2 ways to do this. One is me just talking. And although I find it very engaging, I'm thinking that by making it interactive, regardless of what your background, your mastery, or if you've seen these things before, I think it's going to do a better job of getting you what you want. So I just want to open it for a second, because I don't know what we can get out of this. I'd like to find out. So by the end of this, I'd like to know more or learn about it. Anybody? Anyway.
Just, I guess, Series A terms, what are vanilla, what are not.
Okay. Anybody else? Nobody's looking to get anything out of this. This makes my job so much easier. So this is the way it's going to work. The voice you just heard is one of our panelists. And to some degree, maybe we'll be asking questions, maybe we'll be role-playing with them. And I want to do that starting at 7 o'clock, so we'll have some time to at least get settled in and think about our own positions. Now, how many people have ever seen a Series A term sheet? Just trying to get you right on the answer. Nobody. Is that right? No, not at all. Well, I should say not at all. Depends on how it's structured. And did anybody come to the cap table workshop? Yeah. This is the guy, if you have any capitalization questions. He's good at negotiating here, he's just going to smoke you. So I'm going to have to do a little bit more. And how many of your portfolio companies here have fun? Excellent. Good. We're just just my way of contributing. So I'm glad you guys enjoy. I used to do this sort of thing within a large firm, 11,000. Not the bill. Okay. I've been doing this for about, again, my name is Ettinger. I've been doing this for about 16 years. I came to Silicon Valley right around the dot-com boom in '94. My first client was the largest ISP, Apple Computer, and Intel. And since then I moved one from the public companies and the larger ventures and the big to the smaller ones as they're starting out and through the entire life cycle. That's my experience. So I kind of eat and breathe this kind of stuff.
Why'd you make the change?
From where to where?
Who did they get to see?
Well, I went from Pillsbury Winthrop, to a startup company. And I don't know if it was in the bio, but it was one of those ones where you raise a lot of money and get good names. And then I just sort of wanted to break out. And at the time, the big firm practice as much. I actually was one of those people that enjoyed it. I can't say that about any of my associates, although my partners enjoyed it. Because it was good collegiateness. And I just wanted to try something else. It was just sort of a nice, fun way of practicing. The other thing is being more accessible. Right now, for instance, my firm back built my rate probably closer to about $6.50 an hour. It's really hard to really be with your client every step of the way. You sort of have to make sure you have a team, make it more affordable and more responsive. So it was a different way of practicing where I could really be almost a virtual member of the startup team, being their in-house general counsel long before they could afford it. I think that's it. I'd like to say. I moved down here about 4 years ago. The panel tonight, there's going to be, has everybody read the bios? Because then I don't have to do as much. Anybody did? Okay. And you know who they are. I cut out a lot from the bios. Most of them have a lot more things that you, at least I go, wow, that's pretty impressive. Well, I want to break this out is, I want you guys to think of the term sheet, and these terms pretty much fall into two camps. The control camp, it's about controlling your company, who's going to control it, how they're going to control it. And the payout camp, okay? Who's going to get how much money if there's a good exit, or any exit? Right? If you sell the company, if you go public, if it dissolves. Now, almost every single issue affects both. But I think one's more dominant than the other. What I want to do is break the people up that are here into two different groups. One is the P team, for payout. You guys are going to take a look at those terms. And the other one's going to be the C team, for control. And of that, I'm going to go 2, 4, 6, 8, 10. John, you want to do this, or
What's that?
you want to be on the team?
Yeah.
John is a grad student from SC Business. Ernie is an MBA. So if you want to,
I'll be on the
one
team,
on
yeah.
until we get that. So there's 10 people. Group up with, let's have 5 and 5. Okay, and of those, 2 of you sit on one side and decide who's going to be the investor, and I guess 3 of you sit on the other side. Does that make sense? Let me think about whether or not I want to break it down even farther than that. I think because you guys aren't that far up to speed, you haven't really looked over term sheets much or looked at some terms. It would be helpful to have two people or even 3 people on each side, right? Because you can share information or insight. I'm actually going to throw you in there pretty quickly. I'm just going to go through the key terms that we're going to talk about. And kind of let you in there just to sort of be getting at the feel for what the hell it is we're talking about. Then I'll talk to you a little bit about that, get your feedback, and then I'll start to describe the kind of arguments that you might want to think about, or perspectives that you might want to adopt, and where these terms really come into play later on. And then we'll get really, hopefully by 7 o'clock, we'll have some really when Steve's joining us.
Keith is going to be before 6, before 7.
I teach us really well. It's not like that most recorded before 7. We only work 10, something short. So we're going to need all the time, I think. Yeah. Hopefully we'll have some hairy, difficult ones, or some terms that just piss you off. And what we can do is sort of throw it over at the panel rather than again me pontificating on my experience and what I see, and I'm happy to do that. It should be very interactive at any step. Something's completely clueless, or if you just have something interesting that's or a good question, not a bad question, but it's on topic, feel free to do it now. We don't have to wait till the end. Let me do this first. Let me point out what we're going to be discussing and negotiating. And then you break up and try and do it the best of your abilities for the first time around, okay? That makes sense? So it would be great if we could do, so this is term sheet. First of all, let me describe it. They come in different shapes and sizes, slightly different wording. This is pretty much a Wilson Sonsini literature society format, which is one of the big six. Some of them 7 firms. Minnesota Valley, some might say the biggest. I think everybody would agree. It's one of the cleaner ones. In other words, the language is less difficult, which is why I'm using it. You will, however, see much more spelled out term sheets than this. This becomes more or less this. And I can read pretty much from any page, and it will just sound absolutely wonderful. In any particular jurisdiction in which the company will be required to execute a general consent to service process effective to the registration, qualification, and compliance, unless the company is already subject to service in such jurisdiction or consent as may be required by the Securities Act. It's one of the sections. This is, if all of you guys have key cards over here, the security company is called Carry Systems. Just by coincidence, I used to represent them. This is their Series C, which is going to be a little bit bigger. This is the 3rd round. Than a Series A. But this is theirs. And yours isn't going to be much. Regular Series A is probably something like this, depending on the attachments. Okay? So this sort of alludes, though, to there's sort of there is a one-to-one correlation between this and which documents are in here and what it's going to say. But we asked about sort of vanilla and what's vanilla. Pretty much, even an attorney with very little experience can pick one of these things up and go, where the hell's this section? Or this looks a little funny. This is this isn't normal. There's sort of a range of normal. I hesitate to call it standard. And so we have a pretty good. It's been normalized enough and modularized enough where we can do that. We also know that, for instance, if this term sheet has redemption rights, which is the investor's ability to force the company to buy back the shares that it bought, it probably doesn't come from this coast. It probably comes from the East Coast because it's very, very rare. Probably in up rounds, 6% of the rounds. I probably have actual numbers on that. So we're pretty familiar. Does that again answer the question? Let me start just going through this. So the idea is you're raising money. In this case, what happened is an investor came around and offered your company Techco. They're offering you, what are they offering you? I'm sorry, they're offering you, because I scratched it up in something else, $4,050,000. Mine is slightly different than yours, I believe. That's right? Right. Yeah, sorry? Everybody has one? You know, we should give some action so we walk in. So they're going to give you just over $4 million. And in doing so, they have to value the company. And they're going to value the company. I'm going to say your company, before I put my money in, is worth $6 million. Right? So after I put in my just over $4 million, how much is the company going to be worth? Anybody? 10. It's over 10. 6, give me 4, just afterwards is 10. Basically, you do some math, and we did this in the cap table workshop, so we're not going to get too deep into it, except when we highlight one of the issues. But it comes to that number of shares and that price. And this is very ordinary. In fact, when you look at the deals that have been done over the last 2 years, it's kind of bizarre how normal, what range it is in terms of valuation and the amount of money being put into the Series A. And I've got actual numbers, at least Wilson Sonsini's numbers. I've got these numbers somewhere else. Pricewaterhouse also put something together. But this is pretty typical, which is strange when you think about it. It shouldn't be typical, right? And this is kind of gets owned by Team P, right? Because how much shares these people are buying is going to affect everybody's ultimate payout. If somebody comes around and buys a company for $10 million, $100 million, and your investors own the number of shares that gives them 25%, putting everything else aside, they're getting 25 million of it. So obviously this is a payout issue. If they didn't own 25%, they'd be getting all of the other dumb shareholders would be getting all of it. And I know that going kind of low, don't want to go a lot higher fast. Liquidation preference. And I'm not expecting people to know what liquidation preference is, but who knows what liquidation preference is?
Who gets the money after?
Right. Liquidation preference goes like this. And this is one of the oldest terms. This has been around in preferred stock probably for 150, 200 years. The idea is I have preferred stock. I'm the investor. So I told you guys to wear hats, right? This will help a little bit. You guys aren't wearing them, so I'll do the door. So I'm the investor. My investors have. They don't really wear hats. They have golf clubs and really expensive bicycles. Really expensive bicycles. Here's my thing. I'm a preferred investor. And the one thing about being a preferred investor is if you guys dissolve the company, or we're closing it up, or if you guys sell the company in the future for $2 million, in other words, in my eyes, it's kind of a complete failure. I'm not investing in that failure. So at least I should get my money out first. And this position, I'll just let you know, is not negotiated in general. Very, 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 very few deals get away from that. And by very few, I'm talking 6%, 4%, somewhere around there. Certainly under 10%. The next piece of it is this, is as an investor, I don't just want my money back. I still want to participate with you guys on all the money that's left. So yeah, if I'm putting $4 million in, first I want my $4 million. But after that, we're going to be sharing, there's all this money, it's kind of like brain, right? And each of us has a certain amount of square footage. Let's spread it around. So for the money that's left, we divide it up by the number of shares, and that's how much we all get. But I get $4 million first. Now, what gets argued is whether or not, well, just let's go ahead. That's the investor's position. Now, in this case, the investor's saying, but you know what? I'll tell you what. I'll continue with you guys, but only until I get 5 times my original investment. So I'm putting in $4 million. When there's a buyout, I'll go up to $20 million, and then I don't get any more participation. Now, why would they be willing to do that? It's because the preferred stock, in other words, if it's $100 million, why the hell is this investor going to stop at any number less than what he should be getting? And the reason is because in the lower numbers, I really want my money back first. Okay, if there's a sale at $5 million, I want my $4 million first. Forget about participation. But once it goes into $50 million, $100 million, $200 million, it really, that little bit of money up front now doesn't make much of a difference. So I can put a cap on my participation. Here it's a 5x cap. Because if I really want to, what I can do is convert all my preferred into common. And when I do that, this whole provision goes away. This provision is only when I hold preferred stock. I know I'm going to give you a lot of information. This only happens when I have preferred stock. So when I convert it into common, I'm participating with all you guys, and there's no cap. So I get to choose. Do I want this provision when the actual exit happens, when the sale happens? Do I want this provision, or do I want to participate with all you? So here's one a 5x cap, and you guys can figure out whether or not that's a good thing in your life. And just focus on that provision. Not the other one, because it always happens. Team P, the next one for you is anti-dilution protection. What anti-dilution protection basically is I'm buying my shares at almost $1 a share. Okay? If you sell shares at $2, awesome. I can't wait till we raise money at $2. So now my shares actually are worth twice as much, right? Hopefully we'll end up going public and I'll sell my shares at $10, $20, whatever it is. But if you fuckers, if you guys sell those shares at 50 cents, what's happening to me? How am I losing money?
I thought the stock price was more.
It is. I set the stock price at almost $1 when I bought the shares in Series A. Now it's Series B. How'd you lose your money? You're still holding the shares. You're on the right track. Anybody have any thoughts? These other people are getting shares at 50 cents each. They're getting more shares for every $1 than I got. And now, when we sell, they're going to get a disproportionately large amount of the company for the amount of money that they put in. Does that make any sense? There's a whole bunch of people putting it this way. There's people buying shares. I'd rather they buy shares at $2 and the company gets more money, and I get get less diluted. So that when there's an exit, I get more of the proceeds. So that's simple. Now here's the thing on annual dilution protection. This is something called broad-based. Don't worry about it, because there's very few deals that move away from this. Okay? Basically what it is, again, if you decide to sell shares at a price lower than what I paid for mine, when there's an exit, basically I'm going to get some more shares. I get sort of a sweetener. In other words, my overall ownership in the company doesn't get diluted quite as much. Forget the formula is complex, working through it, we do it in the cap table workshop, it's pretty darn difficult. Forget about it, because you're probably not going to negotiate it much anyways. There's another provision that comes right after, which are the exceptions. You should be able to issue some stock at a price lower than $1 a share without triggering any dilution protections. For instance, you're going to want to grant options, right? And maybe what you're going to want to do is, and this happens all the time, you're going to want to do a polo agreement with Rackspace or somebody. But you need, frankly, a huge discount. They think your company's hot as hell. And so what you do is you say, not only are you going to get that, you're also going to get a warrant. You're also going to basically get a right to buy some shares at 10 cents a share, which is way below our current market value, because our current market value is $1 a share. And you probably want to do that, right? You want to have that kind of flexibility. So what you're going to see is that itemization afterwards. And if you're on the company side, I want you to think about which of those make sense, or why you should care about it, or what you care about. You care about anything. On the investor side, same thing. Okay? Does that make sense? By the way, if you're not following, stop you. There's a lot here. And lo and behold, I put in red sort of the ones that I suggest to you that on both sides you should be concerned with. Pay to play, we're going to stick for now. General voting rights, we're going to stick right now. Protected provisions. By the way, I hope you guys are writing down Team C versus Team P. Okay. I can do it again. I can tell you again. Protected provisions. Protected provisions basically protect me as an investor. So to make sure that you don't do things that hurt my interests is the long and the short of it. What I recommend is that you read through these. Some will make sense to you, some won't. And again, think a little bit about what your position should be in response to these. And in particular, in going through it from both sides, pick 2 or maybe 3 that concern you the most. All right? Skipping. And if we have time, I'm very happy to answer questions about raise rights. Incredibly complicated, not something you'll negotiate much. Won't affect you terribly on either the control or the payout, depending on how you exit. And so that's why I'm trying to get to the media stuff that really matters. Team P gets the next 2 ones, right of first refusal and co-sale. And these 2 kind of come together. So let me describe what they are, and you can think about how much you like it or how important it is to you, and why. So the first one is the right of first refusal. What it says is, I need one company to do. What's your name, sir?
Pierre.
Pierre? Okay, so Pierre is a founder. He's been a founder for 2 years. He's got some shares. He wants to sell them. John wants to buy them. Not an investor, just some dude. So Pierre, I love your company. I've heard so much about it. I love you. I'll be happy to buy your shares. I'm the investor. First of all, there's a company and there's an investor. So basically what the right of first refusal says is that the company and the investor get first dibs on this. You want to sell it to him? You're going to get $2. You got a term sheet, $2 a share. I want first dibs. Now think about for a second why I want first dibs and why the company may not want. Well, I'm sorry, the founder may not want to give me first dibs. The second piece of that is coupled to it, which is this: it's the co-sale rights. Pierre's not going to actually. I'm sorry. I'm not the investor. I'm not actually going to interfere, exercise my right of first refusal. It's okay. It's all him. But what I want to be able to do is force, as part of this transaction, the change it so that I can sell my pro rata amount. So let's say I own 10% of the company. Of this transaction, I want to sell 10% of my shares to him. And again, from both company side and investor side, think a little bit about what's good and bad about this, and what might you have a problem with.
That second one was co-sale, right?
Co-sale rights.
I have a question.
Yes.
You just said referenced the term pro rata rights.
What's pro rata mean? Pro rata means based on your percentage of ownership. So if I own 10% of the company, and he's selling the shares to John, okay, I can't say, you don't get to sell anything to John, I get to sell all my shares to John. I mean, that's pretty unfair. Okay? Either I buy his shares, or if I'm going along with the transaction, I can go along to it, but only my percentage, only in proportion of my percentage ownership of the
So
company.
you can force 2% to sell on the total amount sold.
I can sell mine along with him up to 10% of this transaction. Does that make sense? A little? So those two go together. Team C gets the next one, and it's one of the ones I really like to focus on. You might want to focus on it first when you hit it, which is board election. And here I also want you to think not just about Series A, which would be pretty simple, but Series B. So here's the issue with this investment. You've got two VCs in here. They haven't worked together before. And because they haven't worked together before, each one wants to have a representative on your board. Now, the board, for all intents and purposes, decides the lifeblood of the company. What executives to hire, what executives to fire, what compensation set, what significant business development agreements to do, whether or not to sell the company, who to sell it to, for how much, whether or not they should get other bids, whether or not you should do another round of financing, what price you should do it at. This is really, at the end of the day, the board's decision. The shareholders get to a certain degree, hire and fire board members. But we're not going to get into that too much, except to say that what you can do through a whole bunch of pages here is have different shareholders designate different seats. So I can have one board seat, right? You can have a company, one board seat. And everybody, your Series A, your Series B, your founders, your not founders, whoever it is, each person gets a vote and you all vote for that one board seat. Or what I can do is I can have a board of two people, where the founders get to elect one person and the investors get to designate, basically elect another one. So far so good, right? But here the problem in Series A is we've got two VCs. Because they haven't worked together before, each one wants a board seat. What happens if I have that and I have 3 board seats? This VC doesn't seem to be buying a majority share, a majority of the company, and yet they've got 2/3 of the board vote. So the question is, how do we resolve this? We can increase the common seat. We can push back and say, well, you guys really got to get together. There's a number of ways, and I want you to be creative about it. And I have to say, this is one that gets very, very personal in terms of it has a lot to do with the person's experience. Usually how they got burned the last time and what troubled them the last time. There's not that many creative solutions that we haven't seen before. But feel free to just think, but you need to think about, I want you thinking about the Series B. Because in all likelihood, that Series B is going to come along and say, if it's an up round, in other words, the next investment comes in, and this is almost absolute, and it's a psychological thing. If it's an up round, then Series B comes in, they're going to be buying shares at $4 a share, and they take your Series A books, and they go, well, shit, I want at least what the last guy got. Okay. If it's a down round, they're coming in, and you guys are so desperate for money, and you really haven't advanced, or the economy went bad, and now you're going to be selling shares at 25 cents a share instead of $1. I don't want what the last person had. I want better. And it's just psychology, really more so than necessarily any great position. So assume that your Series B may not want to go along and designate a board seat along with your Series A. And so you have to prepare for that conflict. You might resolve it if you're a founder or in your favor, but you have to anticipate.
On a seed round, for us that are also doing the seed round, on the board composition, is it typical to have 2 founders and the one lead VC?
It happens all the time.
Yeah, but And if the lead VC is trying to do one, where I have, one co-founder, one VC, and then one outside for a seed round, so basically the founders are losing, basically, the control.
Who's the outside?
Has to be agreed upon by both parties.
So an independent,
Independent, yeah,
or not independent, but you're cool with the fact that they're not independent.
exactly.
Okay.
What do you think in that situation is the best thing to do? To agree to give up that control and go one-on-one, or is fight for, the two founders?
Funny you should ask, that's what we're doing. So when you group out, take the position unless you're on the investor side. But I want you to think about the pros and cons of that as well as if you're taking the investor side as well as the founder side. I really want people to try. It's so easy to take your side because you're thinking about it all the time. But really try and think about the investor side of it. I've certainly been more than 100. But, at some point you pretty much know that attorney from Wilson Sonsini, with that VC, they're going to push on this but not on that. And with time, these things change. But a VC is not going to want to look like a fool, but also is going to be very concerned that if you move budgets on one, it's going to be very hard to keep it for future pieces. On the other hand, if he starts giving stuff away, there's this community which is going to go, you're kind of resetting the norms a little bit. Now, what am I supposed to do? Match that so that I can get deal flow? So I'm not looking like the hard ass. So this is also a position that you got to consider a little bit. Because I think it's different from the entrepreneur. The entrepreneur largely wants to, isn't as concerned about looking like an idiot or doing badly around his peers. It's a concern. But it takes so much energy extending in, flowing, and thrive that if you have too much of that, I've never seen an entrepreneur do too great if one of the main things that drive them in life is trying to look good. Because you're spending way too much time actually trying to do great things. That's my impression. So anyways, I want to give that background. And so Team C's got the board election, guys really can think through it a little bit. I highlighted board observer rights. Just consider this a little bit. Keep it, we'll throw it in. Basically, a VC says, well, maybe I don't want a board, I do want a board seat, but I actually want another guy to come and just sit around because, we're training him. It's a good thing for us. We really appreciate it. Anticipate that. Team P, you guys have a big one, which is the next one, and I think the last one that we're going to talk about, which is vested founder shares and the employee option pool. He's the only guy that's going to do the employee option pool. It's going to be very hard to do. Vesting shares. You've been in business for 2 years. When you started, you said, you know what, we're founders, but who doesn't know what vesting is on founder shares? Does everybody know? Who can tell me what vesting is on founder shares? Like show hands. 1, 2, 3, 4. And Sarah. Wow. Good job, Sarah. And over here, John.
Not sure.
Okay. So what happens is, if I give you 1 million shares, what I can do, and what founders do with each other, is they say, look, we have to have an agreement, because if you walk off the job, if you're no longer my partner, 5 months from now, what is it? You take away, half of the company? That's crazy. So we need an agreement amongst ourselves that says, look, the longer we're here, the longer we vest our shares. And then if one of us walks away, we don't lose it. And it's a very personal thing about how much you do. Some people start out with, let's say, a quarter of it. They say, we're founders, a quarter of it, the rest will vest monthly over the next 3 years. So in 4 years total, I'll own all my shares. So you go to the VC, you go to the investor, and you say, and they look at the cap table, and go, well, how many what do you vest in? They're like, well, actually, we vested half of our stock, or 2/3 of our stock, or all of our stock. And the VC goes, that's great, but here's the thing, I'm investing in you. In you. I'm investing in you, and I can't have you, same problem that the co-founders had a while back. I can't have you walking away. If you're my CTO, or you're the spiritual leader of this damn thing, or you're the vision, I can't, you've got the energy, you've been making this happen, you're the one who got it. You walk off with 1/3 of the company, or even 1/4 of the company, and that's an enormous amount of equity going to non-productive hands. I'm okay with giving you some amount of vesting, okay, but we need to reset the vesting basically for the next 4 years. So maybe I'll start you out with a quarter, or we'll start out with a fifth, or something like that. But that means that at least for the next 4 years, if you want all your stock, I can, you've got skin in the game. That's what you always hear, skin in the game, skin in the game, skin in the game.
So that means that the vesting schedule you worked out with your founder up until that point
No longer
is
matters.
just moot?
Yes. It isn't moot. It's negotiable.
Right.
And you say, look, I don't want to do that. I really think that, we worked our, I want you to think about the arguments. There's some good arguments for keeping it. I'm sure some come to your head. I just shared some of the investors' perspective. Does that seem valid to you guys? Yeah. Some of that concern? Okay. Let me break in. Keith's already on.
No, he's ready to go. He's basically got 15 minutes.
What's, of the stuff that we came up with, what's one of the ones that sort of bugs you the most? Or mystifies you the most? Vesting foundation. Very well. Can you also let everybody else know that we're going to push back the participation by until like 7:20?
Is it possible to use shares after the investment? Is it possible to use shares after the investment?
It's hard.
So
Everything is possible.
Right, you just gave us an example that initially was one way, founders have to get.
Yeah, you had to agree to it. They had to agree. And there's a complicated scenario where you may not be able to choose it for future rounds,
Right.
changes,
Right.
but we can not
But leverage in that situation, I'm assuming is the capitalization.
No, I say no.
But the capitalization is the leverage for the change.
How so?
What I'm hearing from you is the vesting schedule change, 50% change based on leverage, I mean, that's what was the funding. So that's why some founders said, sure, add 25%, I'll take the fifth, because I didn't capitalize, right?
It's a good argument. I want to break you the first. No, we're good. On the others to push back.
Yeah, I'm trying to keep in for some reason,
So we can speed up. Okay, color is on. Let's go ahead and break it out. 1, 2, 3, 4. I'll watch this. 5 over here. Who had more? Who had more of these? Let's make this the P group. Okay. So everything that I designated for P, and then everybody over here. 1, 2, 3, 4. So John's kind of working. You're switching up the same. And just amongst yourself right now, you can very quickly decide who's the investor and who's the. And I bunch up. Because I don't think it's going to take at least 2 people on each side. You go top to bottom, you pick one that interests you most, but I'll get started.
All right. I'll be an investor since I'm not. It would be nice to try.
which part of it?
So you want to be an investor with me? Okay. So you guys cool being the founders?
Oh, no, it's you.
It's going to be hard because I haven't.
Hey. How you doing? Good. I'm doing fine. So they very much value. Keith, I don't even know if you've been public, I think you do. Started out as a heckler, and so you certainly know how we work. Although I assume that you sometimes like hiring more than acting as a lawyer today.
Even when I was one, I'd rather do that.
So what I'd like to do is just launch in with one of the first ones before we lose you. So one of the things that really gave.
And Adam, by the way, this is Mike, I just joined.
Okay, all right. If you want, you can drop out for a little bit.
Okay?
Until about 7. Is it okay if you drop out until about 7:20?
Yeah, sure. No problem.
Thanks, Mike.
Yep.
Mike Sullivan from Pillsbury. So one that's giving them heartburn for some weird reason was the VC is asked to change their vesting. They had half their shares vested, and the investor is saying that's sweet, but you need more skin in the game, and I want you to go to where you do a standard 4-year vesting with 1-year cliff, meaning if they leave the company during the first year, they're going to have no shares. And I'll make it a little bit easier. The VC made a terrible mistake when they signed the term sheet. They're a stupid lawyer. This happens all the time. Just put that down. But that isn't what he meant. What he really meant was a quarter of your shares are vested, but the rest are going to invest on a monthly basis for the next 3 years. So basically, taking away a year of vesting from you guys. Does that make sense? And Keith, would you mind playing the investor in this case? I know it's a terrible way to push it. Or have you heard, have you encountered this? And what were the investor arguments that you've heard?
That I'm investing in you, and if you leave, I've got nothing. And I'm coming in right now, and I want to make sure that you have an incentive to stay at the company.
Anybody have a counter argument?
If I keep all my shares vested, I'm more vested, so why would I leave?
What's your vote? Keith?
I couldn't hear him clearly, I'm sorry.
He said, if I have all my shares and I'm vested, why would I want to leave?
Okay, thanks for talking to you. I'm sorry, I'm just trying to be a real investor here.
You say he's out. Nice talking to you.
Yeah.
I think the response to that is that if we're looking at this in later rounds, you don't have, and if the company starts to go down, you got nothing to work for. And I have no way to further reward you, and you have no incentive to stay. If you're fully vested, you can leave, and you still have that same number of shares that you're saying that you have that are supposed to keep you there. So how do they keep you there if you can leave and still have them?
Anybody?
But maybe Keith, we can come to some sort of middle ground, because I've been working for 2 years and had set a vesting schedule with my co-founder that rewarded me, based on some reasonable kind of rate of vesting that rewarded me for the work that I put in that's gotten us here so far. So maybe there's a middle ground of me still being incentivized from your perspective, and me also being rewarded for the work I've done.
That's great, but I wasn't there to agree on that, and it didn't keep you far enough to not need my money. So that's what I thought too. I think that, back off from being the angry investor, I think that you're right. I think where you come to is the middle ground, and a better way for you to grow, because, and I've been in this a lot, and I'm bringing up because he's been in it a lot, and both sides. And I think the better thing for you guys to look at is to accept the fact that investing is going to happen, and start looking at the different events that are going to accelerate. So what's the speed of vesting is probably where you're going at it. Well, what's the speed of vesting, and what are the events that are going to trigger an acceleration that you really care about? Because again, as a founder, and while the stock isn't worth anything, the vesting schedule is not really material. It's only going to be material if certain things happen. If the company gets sold, if you get fired without cause, if it's heavily back-end loaded. So these are the things that you should be focused on more than investing per se.
Keith, there's one statement you made, which I think would come back from Founders Council, which is, you can't get any more stock. I mean, if I have 2 years vested, and you want to keep me, you're worried about, the next 2 years and onward, why can't the company issue me more stock or more options?
I think that's
so that I continue to sit and be motivated.
Yeah, I think that what you have to understand when you go into this, to be realistic, and again, I'm sorry to break from your role playing, I'm not the actor that I should be. I think the thing that we have to understand the discussion is not necessarily driven by logic. It's driven by emotion, precedent, and ego. So when the investor is coming in, he may agree with what you're saying, it may make logical sense, but he's got, depending on the situation, but if you're at this point, the investor has the leverage, and he's going to get what he wants. I mean, it's harmful, it's actually stupid, it's not nice to say retarded, for an investor to actually try to impose a vesting schedule like this. And I've been in situations where investors try to overreach on the amount of equity that they have, and all they're doing is creating a disincentive for the founder. That's the logical standpoint. But from the investor standpoint, they're not arguing from logic. So, like I said, argue as much as you want, and they've heard everything you're going to say. They'll focus more on the things that are important, like the conditions for acceleration and when you really need that stop. Like when it's going to be moved to somebody else, or when you're pushed out without cause.
The other thing that the investor is not going to say, but he's going to be thinking, is at some point I'm going to have control, probably, be able to fire you. And whether or not it's for cause, somewhere around there, there's an awfully good chance that I can get most of your vesting stopped. Maybe get a little bump. When that happens, it used to look like I own, I don't know, I'm with a group of investors, okay, so it used to look like I own 28% of the company. But now, because we repurchased a chunk of your shares, now I own 37%. So that in an exit, I get a lot more money. Also, if I didn't have my majority control before, but I'm very close, and your shares are repurchased, it might push the investors into a majority control. And so is it fair to say keep that's on their mind?
I suppose, but I don't think so. Because, again, it depends on the individual, and everybody's different when they're looking at it. In my experience, no, because in my experience, first of all, when they're in the company, they're treated as outstanding shares, or the capital base, and they're in the cap table. But I think that every investor coming in is investing you, even with the vesting schedule, with the hope and understanding that those shares are going to become vested at some point. If you feel that the investor is coming in thinking that they're recapturing those shares and that's why there's a vesting schedule, that's the wrong person for you to be selling a piece of your company to. Or actually what you're doing is you're buying their time and participation directly.
Yeah. I agree with that perspective, and hey, thank you very much. I know that you guys...
All right. Sorry I couldn't be here more. I appreciate
No.
respecting the time.
Pearls of golden wisdom, well articulated.
I appreciate the opportunity for the improv and the role play.
All right.
Thank you.
Take care.
Good one.
If you happen to be developing a game and you need $100 million in order to do it, then if you go to this, there's full bios of page and a half. Things like Tomb Raider, merchandise and that, it just goes on and on. But I think it's down for that piece, so nobody needs to look at that again. But go ahead and I'm going to push everybody else back by about 20 minutes or so, just to give you guys time to sort of settle in with the group and start going back and forth. Is that cool? Yeah. Yeah, I think because of where you guys are at in terms of your command of this, not so much like going back and forth, but a little bit more about more in a discussion kind of way about if you're an investor and if you're a founder, what's your position? How do you feel about it? What do you think might be a way to work it out? What really concerns you? Does that make some sense? I'm just going to go a little bit. And by the way, I don't expect you guys to get through your entire list. Let's do this.
Adam,
No, yeah.
Yeah, we'll
captured it, because that was one of those things. There's a protective provision. And you'll see this come up in, what if we want to amend the document? What if we want to sell the company? What if we want to do this? What if we want to do this? They had a thing where they have all these basically, the investors want a vote if you do a major deal. What are some of the ones?
Merge or sell the company.
Merge and sell the company.
Do another raise.
Another raise. Liquidate the company. And then further back, then there's more of those. It's in a different section because it shows up in a different part of this massive thing. Then you have a whole other round of those, which are even more operational. Those are sort of life cycle ones. Do we sell the company? Do we go public? Do we do another round of finance, right? But then you have, let's find them. Sorry. Oh, no, you gave it to me.
There's provisions,
What page?
6, near the bottom.
No. Sorry, guys.
What are you looking for?
About page 5 at the top. Let's just continue.
Let's just stay there. It's easy enough. So it's 50% right here. Now, we have two investors. What they covered and they realized is that we have two investors, each are putting in an equal amount. 50% is a little bit difficult. Now, they said, the question was, well, what if we move that number around? You know, what if it's 25%? If it moves down to 25%, what they figured out was it benefits the founders, right? Because in order to do these things, I only need 25% of the preferred to go along with me to approve it, right? Does that make sense so far? I want to do it, let's use another round of finance. I only need 25%. The other person that gets benefited is that minority shareholder, minority investor. Because now he doesn't have to group together with somebody else in order to get a majority or supermajority of 2/3. So, especially in later rounds, if an investor thinks he's going to be in a way minority and not get along with the other guys, you might want that number to be smaller, not larger. And you'll see this, and it comes back again and again in different places. Now, in that section also, one of the things I said is, what are the ones that should really give you heartburn and what you think are the toughest ones? Obviously, acquisition. Another round of financing. Right?
I'm sorry, where are you? again?
I'm sorry, I'm on page 4, protective provisions. The other one that comes up that you wouldn't see, but it comes and bites you in the ass, is on page, it's on page 5, so it's the third bullet point, encumbered or granted security interest in all this, actually all the assets of the company. What does this mean? Okay, it's part of debt. In other words, the company goes and wants to take a loan, goes to Silicon Valley Bank, says, hey, I need $1 million. Silicon Valley Bank says, sure, I'll give you a line of credit. You're a pretty good operating company. You know what though? I need to securitize it. I need to make sure that I have a security interest in something that's worth something. Right? I mean, I'm not buying your shares. I'm giving you money and it's going to be a loan. So what I want is I want some interest in your accounts receivable and I want an interest in your intellectual property. I'm going to be encumbering some of the assets of the company. And here I need a vote of the shareholders, of the investors. Now recognize that this can also be used, this can also be problematic. Because now what happens is, you say, I don't need to raise another round. I don't need it. I could use $1 million, but I don't want to go out and shop this on Sand Hill Road, or even go to my investors and dilute me and the other founders some more. Right? Because I can go to Silicon Valley Bank now that I have a thriving business and actually get $1 million, $2 million line of credit and use that for my operating costs and cost of development and pay my team over in Liechtenstein or wherever they happen to be today, Estonia. Right? This can act, and I have seen this play out, where the investor really wants you to take more money. Okay? I mean, it's one of the reasons you'll see one of the provisions in here that the investor, if they want to, in any future round, you will not get rid of this, can invest more in your company. And you think, of course you can invest more. I'll let you invest more in the next round. But it's such an important thing because as they see that you're being successful, they want to make sure that they stay in. Because from their economics, that is the way that they can make the most money. The they gotta keep, more or less, keep coming in. Yeah.
Can they, in those subsequent rounds, do they have a say in what valuation you're raising at? And like what percent you're giving up in that next round?
What do you think?
No,
Why?
someone else is leading it. Right?
Yeah, so who's deciding on whether or not to take the round? Where does this get discussed?
With your next round mainly fund.
That's right. So he's just gone to Sand Hill Road, he's walking into Pinewood Ventures. Pinewood says, I want to buy a quarter of the company for $8 million as part of your Series B. Now what does he do? Let's go back to the board, right? Are we going to approve this? It's going to be the board that either approves or doesn't approve it, based on basic corporate law. But then what we also have is these protective provisions that even if the board is composed in such a way that the investors, the preferred shareholders, wouldn't win the day, here it says that they basically have a veto right. And maybe they're doing it. One of the reasons they do it is because they do not like that guy. They hate Pinewood. Pinewood, so good way of saying this, I know the word that I want to use. Pinewood really hurt them and offended them in 2 different transactions, and they felt very bad about it. They don't want anything to do with Pinewood, and they don't want you taking Pinewood's money at anything. They would rather see them get diluted at a lower per share price with somebody that they constantly do business with. Why? A, because they get along with them. What's the other reason? Ego. What's another reason?
Trust.
Yeah. Because they share deals. They just gave me a deal. I'm gonna syndicate you into a deal. I want you to buy in. You know, this is what goes on all the time.
Relationships.
Relationships, it's reward as well.
So how does that play out? When they say, no, I don't want you to go with these guys, but then do they still get the same deal that they were offering, or do you get to still get the same?
Not necessarily. There's a whole bunch of legal issues with it. If a board of directors decides to take a less good deal, have you ever seen like there's an acquisition in the news, and then there's a shareholder derivative suit where they go, what the? You sold it for that? You didn't even shop the company. It was trading at $12 and you sold it for $13. And our growth was there and everything else. How can you do this? You didn't shop the deal. We know for a fact that you got a tender offer for $24 a share that you ignored. You're not, legally, you're not supposed to be able to do that. In private companies, in the situation we're talking about, it's a very hard to enforce those rights. That forces the board to do the best. Right? So this is sort of, if you're giving them a veto option, look, they probably want the same thing you want. They want the payout, right? And all things being equal, you get more, they get more, so they want the best deal. They want the most money at the least amount of dilution, right? And the right investor. Okay? However, both of you may disagree about what the best next investment is. Or whether or not you should sell the company. Okay, you guys have been working at that company for 6 years. Maybe it's time that you guys work 4 years or 3 years. This happens all the time. Okay, right now you're worth $60 million. Well, that's more than $60 million. Well, you know, I'm going to take $20 million off the table. It's awesome, fantastic. Me and this guy, you know, whatever it is. Okay, the investors going, you out of your fucking mind. Are you kidding me? Look at your company. This is the next Starbucks. This is the next one. This is like you're at the beginning of your value curve. And by the way, they're right in this case. I'm giving you a hypothetical. They're right. You're at the beginning. And to them, a $60 million exit, if they're a $600 million fund, is crap. I mean, it's not crap. It's better than losing money. But it's not the home run that they need in order to keep the fund, to return the limited partners' money. Because don't forget, they have their investors.
The pro rata purchase right, that's not an automatic veto right? I can still go on to next round and say, I'm taking that money, but it's your option whether to come in or not.
Under which term?
The pro rata proportional ownership one.
Like, show me
I mean, like, it's the right that they can purchase into the next round at the same ownership that they invested in the previous round.
Yes.
That's not an automatic veto. They can't veto.
No, that just says, wait, you want to sell $8 million worth of shares? Well, I have 12% of the company right now. I want like 12% of that. You can't sell all of it to Pioneer.
Yeah,
because I want 12% of the deal.
Can the next round guys veto that? Can they come in and say, screw that.
How can they? We're coming to an agreement. I mean, they can, but I have to agree with them. We'd have to agree with them, right?
They can still veto the whole thing if they have this. The
Yes, that's right. All right, we're in there with four. And Mike, you know, Thor and Mike, we got into something that I think is a big one, which is, you know, is protected provisions. And I think, Thor, are you pretty familiar? I know Mike is. And by the way, do you guys see each other's bios? You know who you are? Should I introduce you to each other? Oh!
I read all about
Lee
it.
as well. I'm sorry, Thor?
I read all about him and everybody else.
All right. And Lee, so Lee, do I need to introduce you to Mike Sullivan or Thor Miller?
Hey there.
Hey guys.
And by the way, Mike doesn't have a webcam. So, you know, everybody's a little bit concerned about protective provisions. You know, it's this idea that the VCs come in, and even if they don't buy a majority of the company, or, you know, even if they do, but let's say they only buy a third as Series A, that suddenly they have what looks like to the founders is a veto right over subsequent rounds of financing, and as an acquisition. You know, they can negate an acquisition if they think the company's too early on in the value curve. So, Mike, let me start with you. What's the investor's take on this? Why do you need that?
Yeah, well, I think what the founders ought to expect is when they take money from a venture capitalist, they're basically entering into a partnership with the investors. And the sort of social compact or the deal you have on both sides is that, you know, no really important transaction like an acquisition or future financing is going to happen without both sides being in agreement. I mean, there are ways to deal with protective provisions in some cases. You can say, for example, that you'll have a block on a financing unless the financing is at some multiple of the valuation you're investing at. I have seen that before. You can do the same thing with acquisitions. You can put pricings around multiples. But in general, the investors say, look, if you don't sort of trust me to make good decisions, on those kinds of issues, then this is. And they don't say that, but that's what they say to me. Is that that's sort of the deal that you're entering into with your VCs, and you got to pick VCs that you trust to be good partners in the future.
And Lee and Thor, both of you could play on the founder's side. What would be your response to that? And assume right now that Series A is buying a third.
Yeah, I always look at this as the price of doing business with venture capital. I've never known a VC who was willing to waive most of those protective provisions, especially related to mergers and acquisitions, which are the ones we care most about. So the issue of really being comfortable with who you're getting into bed with is very good advice. And I've personally been burned by this, where I've had VCs who blocked deals, perfectly good deals, because it wasn't in their interest. And it makes sense from their standpoint, and I get it.
How so? Can you give just a little detail? I know you're probably going to give a lot.
Well, I'll give some context. Let's say, and the example was that we had an offer on the table by the company where the founders and all the early investors would have done very well. And the latest round, a D round, they were not getting the multiple they wanted or needed out of it. And so they would rather roll the dice, even though they would have made a return, reasonable return. It wasn't an excellent return. They'd rather roll the dice. And it's very clear when you talk to these guys, when you're pitching, that their business model is all about big wins, right? And when you're an entrepreneur and you're pitching these guys, you're telling them what they want to hear. We're in it for the with as well. And of course you are until you have an offer which comes along, which makes you a very wealthy person. In which case, you know, the small to mid-sized annuity seems just fine. So yeah, I just feel like this is part of the game you play.
Understood. Lee, you have, and feel free to chime in on either side of this. I mean, I think since everybody here's a founder, it's really hard
to
get an investor perspective.
Sentiment that you should know who you're getting into bed with and try to be comfortable that they're the kind of people that you can actually have a conversation with about this issue when it comes up. You know, I've certainly heard and seen situations where people just draw a line in the sand and will say no. I do think it's fair that, you know, as a package of protective provisions, there are going to be plenty of protective provisions. I do agree with some of them being kind of non-starters from the VC's perspective, but I do think that it makes a lot of sense to me to say in a document that if we achieve a certain return, that veto right is going to go away. And, you know, having that conversation, I think is a starting point to figuring out if you're partnering with or in bed with somebody who you can work with. I actually, when the company I was involved with, we were actually making a venture capital investment, and the founders insisted on that, and we had a conversation, and we actually gave in on that point. But, you know, it was part of a package of gives and takes, and so, you know, we certainly perhaps got some more coverage elsewhere in our negotiation, that particular deal. But, you know, I personally, as a founder, really don't like having an absolute veto when it comes to that, and so I would try hard to negotiate some comfort level that if a certain return is achieved, perhaps within a certain period of time, that the deal can become, it can be approved out of veto.
The question is, are you going to get anything that is actually very meaningful? I mean, most professors will say, yeah, I'll agree to, if you give me a 10x return on my investment, I'll put that in there and waive those rights. But, you know, how aggressive, I don't know if you've ever done this negotiation, I mean, particularly with M&A, how aggressive do you?
I think this just my perspective, I think this very hard every time. At least on the founder side, of the company side. I'll say founders when you say company, it's unclear. But from the founder side, I hit it very hard every time because I think you never know exactly how much leverage you have until you start trying to find out. And as Thor said, you know, it's very hard to predict the future and exactly how people are going to go. I want to ask one question, sort of a technical question to Mike, which is, does the percentage of approval really matter to you as the Investors Council? How much, what percentage, and does it have any effect as you go into Series B and C?
Well, as Investors Council, I just want my particular client I want to maximize his control or her control over the future. So I think from the company's perspective, they want the percentage to be as low as possible, just to facilitate a deal. And from the investor's perspective, like in our example, you've got two equal kind of lead investors and then a very small group of small notes converting. So that means, you know, one or two of those tiny notes together with either one of the big investors can rule the day, which makes me nervous as Investors Council. If I've got one of those big VCs as my client, I'm going to say, you need to get 60% or 2/3 or you're in trouble. So you're always just looking to the number that's going to give your client the most control.
Aren't you also worried, though, in that case, that in a round or two, whatever it is, that your client won't, if your client's going to suffer the same problem that Thor put out, which is, you know, they don't want to sell the company, you think it's a decent return, but now you can't garner the votes in order to make that happen.
Yeah, but I think you can't have everything, and I think I'd rather be able to, you know, to have a say.
So
to have enough stock to have a say.
Does anybody have from the founder side? Does anybody have sort of a push that you haven't heard yet? this is one that I'm just listening to what you're saying. And what you're saying is that on the investor side, you shouldn't be getting into bed with an investor that you don't trust. That when it comes to these existential, life-changing, very serious milestone points for the company and everybody involved in it, we need to make sure before we close this thing that we're really comfortable with each other and that we always wanted smart money, that's true. We think that you're it, both these investors, and we really think that you're going to have, frankly, you have a lot more insight into what makes a good acquisition than we do today. But here's the question I have, because up to now, we've been, having lunches and all that sort of stuff, we keep hearing that you're investing in the team. And it's this team. Isn't this kind of saying that you don't trust us? And if you do trust us, or if you believe that the founders are really the company, why aren't we getting the same protective provisions? In other words, really this protective provision doesn't say you have to do an acquisition. What it says is we don't want you doing that. And as the founding team, and the people that you're saying, are so great, and we're my clients are the people that you're investing in. Shouldn't we get that sort of same right, not to push you in necessarily to an acquisition or to a round of financing that you don't want, but to be able to say this is the right one? Anybody can take that. Lee or Mike?
I'll jump in. In a typical Series A financing, what you say is, well, you have that right already, because no financing and no acquisition is going to happen without the management team being on board. And in the usual situation, the founders control the board, or they have a 2-2-1 or some kind of structure that where the investors don't really control the board. So that sets up a situation where both sides have to agree to go forward with any major corporate transaction. Management, either because they control the board or just because the natural way of things is that no financing or acquisition is going to happen where management is just opposed. So you've got, in essence, you have both sides with effectively a practical veto.
In my experience, the real business happens at the political level, and a lot of that is encoded in the law, in the contract, but a lot of that is very relational. The board, even, early on, so I found that this is really not a huge concern in the very early days, because most of the, especially seed rounds, the closer you get to large dollar amounts, you get to a lot more overhead in terms of the board, and a lot more power plays on the board, and so managing that is quite challenging. And you see a lot of CEOs, I've been amongst them, who essentially don't do a great job of managing the board, and so or do a great job managing the board, and that's where the influence comes in. More so than that. That's what ends up mattering more than the law at that point. That's in the contract.
How the board members, the relationship between.
Yeah, to what extent can you influence other board members and other investors?
Yeah. That makes a good segue point, actually, because I think another one of the big ones here that's always a quandary is what the hell do we agree to as a board? And in this financing, you may not be able to read it on paper. But the scenario is such that, there's two venture capitalists and they haven't worked together before, and they feel uncomfortable taking a single board seat, even though this is a Series A. And so they really want each one their separate board seat. And in fact, one also wants an observer that they can take along. An observer that we didn't get into, basically it's somebody that comes and observes. That's it, but they get to come to every board meeting. And sometimes they participate more or less. So, did you guys, what came out of your discussion about that? About something you guys would feel comfortable with having 2 seats, 2 different VCs?
Well, how many seats total are there?
That's a separate question. What if you only had 1 seat?
So when you have a 2 founders, 2 VCs, and you're trying to get an independent as the 5th, who makes a suggestion of how that process works?
Lee? Did you hear the question?
What's that?
Did you hear the question?
I did not hear the question.
All right, so the question was, if you have a 2-2 board with 1 in plus 1 independent, how does that process actually work? How do you guys figure out how to pick the independent?
One more time, sorry.
No, sorry. I'll come around. So if we accept that the VCs are going to have 2 board seats, but the founders and common want to designate 2 more board seats just to even it out, and then they both agree, we really do need at least 1 independent so that we can make decisions. How is it that you go about making that independent? What's the process? That was the question.
How do I, as a founder with one of 2 board seats, pick the independent?
Or give us your investors' perspective.
Sorry for the ruckus in the background here. I'm not sure if you're picking that up.
No, that's your new Python coder, right?
Sorry about that. Look, I think it's an open conversation as to who would be useful to the company, who would be truly independent and value add to the company, and finding a fair value add domain expert, if that's particularly helpful, which it probably could be, and finding that person is putting our heads together and seeing who we know that could fit that description.
So I'll hit this just because I want to try to close it up in terms of time. What I would say is it tends to be somewhat informal. It tends to favor the VC because they usually have a larger Rolodex. So they're going to reach out within that Rolodex, and they're just going to sort of start cold calling usually. But the founders need to feel comfortable enough that although there's a relationship there, the person's going to be independent, useful, that they speak the founder's language. In other words, they have that kind of operational experience. Okay, that they bring that kind of value to the board as well, that they can at least see your side of it, and you have a good feeling that it's independent. If you are arguing about this too much, this is the wrong investment for you. This is actually a great way to see how well you guys get along before you close the deal. Okay? And I would suggest that you can put into your deal book, there's conditions of closing. And one is usually we figure out who that independent director is. Sometimes you don't have that. Sometimes you say, we'll close the deal. Okay? And then we'll figure out who the independent director is. And I would suggest you to actually make sure that you do it before the closing, just to see how you guys are working together. Does that, you guys agree, or?
Did you say that you want to actually pick the independent director before the closing, or just to talk about it?
Well, it doesn't necessarily have to be a condition of closing, but I strongly recommend that you do agree on one. And frankly, I would actually make sure that he gets appointed as part of the closing docs.
That's good advice, because I've often seen the 5th independent seat sit empty for a very long time, because it's so easy to deal with other things. So if you can do that, I think it's great advice. The other thing is,
and Thor, I'm going to, only because I can really predict what you have to say about it, right after Series A having a 2-2-1 board. But Mike, how does your client think feel about a 2-2-1 board, one independent?
Well, I think my client feels like it's fair because this the board makeup, I think, generally follows the stock ownership. And in this case, it's very, very close. I mean, the common and the preferred have very nearly the same amount of shares. And so I'd love to have 3. That's really the right structure given the share ownership. So we're okay with 2-2-1. I agree that it's really common to see that 5th seat go unclaimed for a really long time, because it's easy to say before the deal that we're going to do that, and then one thing leads to another, and so you can have a 2-2 board with a potential for deadlock that lasts a really long time.
Are you going to be worried about that? In other words, is that something when you're talking to your client and they say, well, when are we going to pick that? Are you going to say, don't worry about it, work with them to do it? Or are you going to say, we really need to get that fifth person sitting there before, on the day, by the day of close?
Well, the honeymoon will last for a while, so it's not urgent the first month or the two, but or two. But I would tell the client to don't forget about that board seat, because at some point down the road you may find you really can't agree with the founders on something. It could be that one of the founders needs to be needs to leave the company. That's very common. Not very common, but that's a common situation where this kind of board makeup really matters.
Now, Lee, let me change the hypothetical a little bit into your role. You and I are co-founders. The difference is you're smart and experienced, and I just know Python really, really well.
Far from it.
Huh?
Far from it.
There's something that's making me feel nuts about this 2-2-1 board. I'll tell you what it was. When I was at the Media Lab, there was one professor that thought, we needed to make things more democratic, and he set up this sort of committee to decide what we were going to work on. And it was exactly the same. It was this 2-2-1. And it wasn't that anybody was an idiot. It was just so hard to manage. And, we were running after that fifth member all the time to get their vote. Sometimes they weren't apprised of the issues, they weren't up to speed. This just seems to me to create so much complexity. And I understand, my understanding is that, and my attorney our attorney actually said, for Series A, it's pretty uncommon. It's much more usual to have the two investors just pick one guy. The founders pick the other guy and have one independent. It just seems, do we really want this much difficulty this early on? I mean, if it's the C round, I kind of get it, but this early on, I'm going to have to. The other thing that used to happen is I used to walk in, and suddenly everybody chimes in, and it's like we've got to take everybody's opinion seriously. And suddenly I've got, two investors, and there's going to be some other guy sitting in there, and the independent, and it isn't that they have bad ideas, but, suddenly we're going to, we're going to be gamifying our product, and it's security for enterprise. So what the hell's going on? And I'm just worried about that. You've got more experience than me. Is it something you're worried about?
Practically I'm not, and just based on my own experience, I spent 7.5 years at one company where we had many classes of preferred. Even as our board got more complicated, we operated for a very long time with an even number of board members. We had some observers in the room, but we had an even number of board members. And honestly, I cannot remember a scenario or a board vote that was not unanimous. In other words, every single board meeting, there was debate, and there was sometimes conflict, and sometimes deep debate, deep conflict, but we generally, I can't remember a time where we left the boardroom without having a unanimous decision. And so, at the end, my experience has been, it's kind of irrelevant if it's 2 or 4. Yeah, I mean, I get practically it makes sense to have someone to break a deadlock, sure. But I think it's more important to come to a consensus, and that's what I've seen. I've been in situations where, the interests of founders, other members of management, and a variety of classes of preferred all vary pretty greatly. But at the end of the day, there was a negotiation, a process, and discussion, and we got there. So just based on my own experience, I can get how people would feel the urge to want to have an odd number of directors to help avoid that. I've actually never had it be a problem for me.
Okay. I'm going to ask our, we're going to move on to, because it's close to 8, and hopefully we can do this. Thor, I'm actually moving you to investor mode. Because now you're an angel, and you get satisfaction worked out really well. You're hanging out with your wife a lot more, I know that. But you still want to stay in the game because, let's face it, they're all your friends and probably going to be at your place someday. So you're doing some angel investing. Mike is actually my lawyer. And he pointed something out to me. And Lee, you're investing as well. You see, I was all that the valuation of the company was $6 million pre-money. That's an awesome thing. And you know, we thought that was a fair price. But we sat down with it, and one of the things on the back said, we need to make sure that the available options are increased to 15% of the overall capitalization once the deal closes. And you know, right now, you know, if the deal closed, it would be significantly less than that because we've been operating for 2 years, we've granted a lot of options. You know, and Mike did some numbers with us, and what appears to be happening is if I create that option pool before the close, the way this whole thing gets calculated, it seems to me that $6 million is my real pre. We actually didn't go over this here because we didn't have time. So let me actually just talk to the guys over here real quick, because they're in the company. Here's the issues. They want us to increase the option plan. These are shares that have not been granted. They say that, you know, we need an operation. We're going to do business for the next however much. We need 15% of the company. Even though we've granted options, we need another 15% available. But if we create that beforehand, then the way they calculate the shares, because it's $6 million, well, if it's $6 million without that option plan, that means each share is more expensive, right? If it's $6 million split into all the shares, including the option plan, and it gets calculated that way, each share, I'm sorry, did I say it right? Each share is more expensive, each share is less expensive. Does that make sense? Because there's more shares. Which what that does is it actually reduces their share price down to this just below $1. So even though we're saying that the pre-money valuation is $6 million, Mike, or actually Mike, I don't think it was you, I think it was the associate that works for your associate, pointed out that, you know, the effective pre-money valuation is actually about $4.2 million. And, you know, I don't mind putting in the option plan if you guys really think it's necessary, but I'd like to put it in after the close, so it doesn't affect what the real valuation is. Lee and Thor, you know, do you get the issue?
Yep.
And Thor, you first. I mean, I thought you were my bud. So what's going on?
Well, I mean, Lee, I understand when you're to run this, I'm playing the angel, right?
Yeah.
So, I'm investing in a business which has certain expectations of hiring and retaining employees, and part of that is having an option pool in hand to do that. So I expect that you to essentially take the hit on that dilution as part of running a viable business. I don't want to take that hit.
Yeah, but we're partners. We just got done saying that. That's why I gave you the agreement and all that trust and stuff. So, I mean, if I'm taking the hit because we have an ongoing business, and, you know, and I get that I'm going to get diluted if we actually have to hire all these people, that we may actually grant, you know, 15% of the company, and maybe those options will vest before we sell or something like that.
All right, I'll level with you. We do it this way so that we can make it seem like you're getting a higher pre-money valuation than you actually are.
Yeah, that's not. The next one is, my understanding is actually, what I know it's so hard for you to take this position. My understanding is this is absolutely standard, is what you said. I think, Thor, that's enough. If you'll allow me to do so. Lee, do you have a justification for this? I'm not saying I'm totally cool with 50%, totally cool with increasing the option plan. Let's just do it after the close.
Yeah, look, I'm putting $4 million in at a $6 million pre. I'm going to own 40% of this company. And you set everything up that we need to succeed before I make that investment. And that includes having sufficient options to do the hiring and having what you need to motivate your employees.
Mike, I'm exasperated. I just don't get it. I don't think I'm getting my point across. Which I am, but so, I mean, can you help me out here? I mean, can you articulate what I clearly am not doing a good job at, so at least they can understand it and we can get it?
Well, I guess the point is that you're not ending up with 40% of the company, you're ending up with effectively half the company, because at least half the votes, the voting stock, are pretty close to half the company, because that option pool doesn't exist yet. And those options are not going to dilute you, they'll only dilute management, and you're effectively ending up with, 47 or 48% of the company.
And
My expectation is that you're going to be issuing those options and you're going to be hiring to grow this business.
Well, let me, for the sake of time, let me propose something, because I want to close this deal and actually go on with our business. And Mike is, expensive, but worth every penny of it. And, you're saying 15%, okay? And I get that you're saying it's standard and all that kind of stuff. And I guess your position is that I need to take the dilution, and that's just sort of the way that you want to value it. Where I think we should share it. But, okay, let's say we need the 15%. I don't see that, because actually we've been working hard. We have 2 years of operations. We've hired a lot of people. And actually we work with an executive recruiter. And, we have numbers on what we expect to hire for each of the positions as part of our business plan for the next 2 years. And at most, we're going to need a total of about 8% of the company to increase the option pool. So let's say I just go along with this as the cost of the deal, even though we may not understand each other or agree. But can we at least agree that I don't need to go to 15, that we just take it out to 8 or 9%? Because that's the plan. As far as, and you got to trust me on the plan, because we're the guys figuring it out.
Sure, let's do that.
Is that, Mike, if you're the investors council, is that a proposition that tends to work?
I think it is definitely an approach for founders to take and say, let's do a bottoms-up review of the options. Let's not go with 15 or 20% just because it's in your standard term sheet. Let's actually look at what we think we're going to need. That's totally fair. And I have seen investors go along with that kind of approach. I'm working on a term sheet right now where the option pool, and I'm representing the company, but the option pool is going to be 6%. Because the founders have demonstrated to the investors successfully that that's, they're not going to need to make any big hires. It's going to be kind of rank and file.
Or at least if the company, and I'll chime in, this is what I experienced. It means a lot of extra work for the founders if you haven't actually figured this out yet. And maybe unless you've got a fair amount of business experience or acumen, it's a hard thing to do. But in many cases, the VC will help you. Or there's a good time, if that independent guy has operational experience, it's a good time to find out whether or not the rubber can hit the road and help you think through this, and whether or not they'll actually help you do that. It's a good time to actually bring them on board if you can. So, but usually the VC gets that. And what you're doing is, at that point, you're also sharing the risk that if the company goes sideways or goes long, and you actually need to exceed what you expected, that yes, they'll get diluted, but it is not what either of you are projecting, so you feel much more like you're standing side by side. I found that it is trying to get rid of this. In other words, say, yes, we'll expand it to something, but it'll be post-close, instead of so that the shuffle doesn't dilute only me. It almost always goes nowhere. And I mean, well past 80%. Is that your guys' experience? That you just can't get that out?
Yes. In part because when people talk about valuations in Silicon Valley, they've got to have kind of a common understanding of what all the other pieces, how they work. And the common understanding, I think, is that there will be an option pool that will be a pre-closing option, or that will be, that won't dilute the investors. That's the assumption that everyone based valuation on. And sure, you can have the option pool set up after the closing so that it does dilute the investors, but then the investors would say, well, then I want a lower valuation.
And that's a really good response. If you're investor counsel, it's like, oh, look, this is, sorry you don't speak our language yet, but when we did this, the valuation was based on the idea that in fact you're going to have an option pool that reflects, what we think the growth of the company is going to be, and that's going to be done before close because that's the way we always do things. And they'll be right. That is the way that pretty much they always do things. So I agree. Any other questions for the panel? Because we're at the top of the hour almost.
Yeah. kind of a softball for you, but as a CEO, all you want to do is run your business and build it, and quite frankly, me haggling over the legalese in a significant way every time we do a round, I want to know what's being negotiated, which is why I think this panel is really valuable, but I also want a lawyer who is going to remind me a year from now all of these things again and be sitting there being like, here's what we should try to do. I just want to make sure that that is your job or these guys' job or whoever you find to kind of represent you at that time to be pointing all these
I agree with you. Do you have a question?
No, not just, I wanted to make sure that we're not, left to our own devices here at this point because, I can see myself, missing a lot of this stuff.
Panel, if you could chime in, this man is unique as a CEO and actually not wanting to spend all of his time dealing with, Mike, you can't see this, I actually have Carry Systems Series C with me. Mike was around when I did this. The reason I brought it is actually the security for the building is done by Carry Systems. But no, I haven't let anybody look inside, I just wanted to get a general size of the way. For some reason, he does not want to go through this terribly thoroughly, or it sounds like, even getting all the nuances on the term sheet. Do you guys have advices for how the founder should actually work with it? There's no question they should have an attorney. It was good and qualified, it makes them feel like they're being both represented, but they also understand how to navigate the waters in the best way possible. But beyond that, do you have any tips for how to work with the attorneys to get this deal closed?
Well, was the point, I thought the point was that in the future, after the deal is done, the founder wants an attorney who will be kind of looking out for how the deal docs affect future actions. And
No, it's actually as you go into this, they get the first term sheet, they come to the VC, they get the term sheet the next day, hopefully, and now they're holding it, and the question is how to get from that point to close, and what would you advise a CEO about how to work with their attorney best to make that happen?
I would say, spend most of your time on the term sheet because the term sheet's what matters, and the deal documents that come later are really the province of the lawyer largely. But even with respect to the term sheet, a good lawyer should be able to help the founder, the CEO, with what's important. Because even in a term sheet, 85% of it just isn't that important. I mean, I had one VC tell me if his lawyer negotiates the registration rights, he's fired. So there are things that matter in the term sheet, but there's a lot that doesn't matter so much. So a good lawyer will be able to say, here are the 10 or 12 things that we ought to talk about.
But what about in terms of, do you let the attorney lead? Do you let the attorney lead until things get clogged up? Do you make sure you lock everybody in a room? Do you have all, what are things that you've seen are very successful in making sure the deal closes as quickly as possible, but also in a positive way that leaves good feelings, and the founders have done almost the best job they can do to get the best deal. I mean, if you have any tips, any more sort of tips, Lee and Dora, we'd love to hear.
I think having an experienced lawyer is certainly a starting point. Somebody who understands kind of what the market is. I mean, you can have a great lawyer who just doesn't understand what is happening out there in the real marketplace today, and so I think that's pretty important. But yeah, Mike's point is dead on. Focus on the term sheet as a CEO. There's 10 things that you really care about. Make sure you have a good grasp of what those issues are, and leave the rest of it to the attorney, and let him close the deal. I certainly see cases where business people get in the way. I've seen cases where the lawyers get in the way. It's probably not a rule that one is always the blocker. But if you're really not interested in this stuff as a CEO, then you have to really trust and rely on the lawyer. But I would say if you're not interested, that at the very least you should find another CEO you trust, and just make sure that you have an understanding, kind of another view as to what are the points you ought to at least focus on and pay attention to. If your CEO is going to be, a lot of things you're not going to want to deal with, and this may be one of them. This is a pretty important task for the CEO to get through and understand the issues quickly and know what to fight for and know where you can give. Because at the end, as I said earlier, this is all one negotiation over a package of goods. You're going to win some, you're going to lose some, but getting that package together and agreed to fast is in your best interest. Negotiating point at a time and fighting and getting your heels on every point is not how you get a deal closed. And I have seen people who want to actually go through it. You may have a different view, but I've seen people who want to negotiate point by point and dig in on everything, on every point, and really think taking kind of a packaged approach to this makes sense, understanding what is typical in the market and trying to stick fairly close to that unless there's some immediate concerns makes sense. It's in everybody's interest to move on as quickly as you can.
Is there if I can ask a follow-up, which is, a lot of times the lawyers do get bogged down. And, he's an idiot, and, you call your lawyer and they go, this associate is just an idiot. And the associate on the other side is telling the partner, this guy's completely unreasonable, he doesn't know what's going on. What should be the flags for the CEO to say, I need to step in and have a all hands meeting, with the investors council and the investor, or I gotta go take the investor to lunch, or he's gonna take me, and, we gotta figure out how to, because this is getting bogged down. How do you know, what should be the flags? Do you have any sense of that, either Mike or Lee?
I would say if it takes more than about 2 back and forths for the term sheet, 3, if it gets to 4, then something's out of whack. And I would say the back and forth with the term sheet, in my experience, usually the lawyers are not leading, they're in the background. I don't know, others may have a different experience. But typically the lawyers are involved and they're commenting on every draft, but it's the founder or the VC that says, here's what we think, here's our markup. And then at that point, the founder can say, well, these are some of my lawyer's comments. If it's challenged, you can say, well, I got to get back to you. Those are lawyer comments. But at the term sheet phase, I find that the back and forth is usually between the founding team and the VCs with the lawyers in the background.
Yeah. Well, thank you guys. I think I really appreciate your contribution. I think it's been excellent. Mainly because I agree with everything you guys said. So, but seriously, I really appreciate you guys taking time out of your night and participating. Guys, anything else? Good. Thank you very much. Thank you.
Good help.
Take care.
Thanks, guys.
So closing statements, Michael.
Yeah. You gotta, especially when you're doing it. Lawyers are sometimes put in very difficult positions. Because if one thing comes up and bites you in the ass, supposedly they're the ones that didn't bring it up to you, or didn't tell you how important it was. So in a weird way, one of the great, and after a while, the lawyer gets to know you and understands your heart, your buttons, and what really drives you and that sort of thing. And hopefully, when you do that, the work is easier for both of you. But especially at the onset, most lawyers' inclination is actually to give you more comment and more notice. And it's not just to cover their ass. It's because they feel like they need to apprise you. And it's your job to make sure that they're telling you how important these things